My name is Emily Mahoko. I'm the Fund Specialist at Momentum Collective Investments. Domestically, the SARB increased their pace in hiking with 2 consecutive 75 basis point increases in July and September MPC meetings. We remain of the view that the SARB will continue to hike in step with the global central banks. Over the quarter, we have seen the OBI delivering positive returns, still outperforming South African equities and property. Cash was once again king for the quarter, returning above 1%. The inflation-linked index, as measured by the SELI index, returned negative 1%. I'll now be looking at the Momentum Money Market Fund. The fund invests in short-term fixed income instruments issued by banks, South African government, and South African corporates, with a maximum term to maturity of 13 months. The yield is returning to the money market. Rates rose across the maturity spectrum. We are increasing our floating rate exposure, given the interest rate trajectory to be able to benefit from resetting benchmark yields. Bank NCD rates increased in line with the high rate view. The 12-month NCD moved from 7.5 to 8.35 at the end of September. As we have mentioned in the last quarter, for the first time in 3 years, we are seeing real rates in the cash markets. We are still locking in these elevated rates for the benefit of our investors. Cash remains a safe haven for investors concerned about the growth outlook in South Africa and globally. We remain of the view that the SARB will continue to hike for the rest of the year. The Momentum Money Market Fund has managed to outperform its benchmark of STEFI over the relevant time period of 12 months. I'll now be looking at the Momentum Enhanced Yield Fund. The underlying range of instruments in the fund are used as tools to actively manage the fund's interest rate risk. We have increased our floating rate exposure given the interest rate trajectory. We have seen attractive opportunities in the offshore debt of local companies and have allocated capital where the valuations were attractive. We aim to generate a high level of income from the credit assets in the Enhanced Yield Fund at a low level of duration risk. We view the income generation capability of credit spreads as the important driver of overall returns in this fund. We remain a valuation-based team with a risk-adjusted focus on returns. We believe there are good returns for clients over the next few years in South African fixed income market. At the heart of our investment philosophy lies our key focus on risk-adjusted returns. Liquidity is provided through tradable assets that the fund holds in bank instruments, which can be converted to cash quickly. The Momentum Enhanced Yield Fund has managed to outperform its benchmark of STEFI plus 0.5% over the relevant time period as well. I'll now be taking you through our best of blend income fund, which is the Momentum Flexible Income Fund. Nominal bonds have experienced a tough quarter and year due to high inflationary and hawkish central bank environment. Global nominal bond yields have sold off and returned low to negative numbers. We are, however, still of the view that nominal bonds will deliver decent real returns over the medium term given the inflation and growth outlook. It is the first time in more than 20 years that we have seen the dollar trade below parity into the euro. The South African inflation-linked bond yield curve remains steep but less attractively priced on a real basis. With inflation expected to average around 6.5% and 5.5% over the next 2 years, the 10-year inflation-linked bond trading around 4.5% real looks less attractive from a valuation perspective. We have reduced our overweight view on South African inflation-linked bonds. Break-even inflation levels are elevated and closing of the break-even inflation spread will benefit nominal bonds over inflation-linked bonds. We believe the Flexible Income Fund is structured to deliver on its mandate of positive real returns over the appropriate investment horizon. The fund has therefore outperformed its benchmark of a CPI plus 2% over any 3-year rolling period. From an outlook perspective, we remain of the view that South African income assets are attractively priced to deliver high, nominal and real returns over their appropriate investment horizon. In the short term, the volatility in markets will create an uncomfortable ride for the remainder of this year. But as central banks high grades and inflation returns to normal levels over the next year, we can expect more attractive returns from nominal bonds. Thank you.